Peter Cardillo joining in. He's Chief Market Economist at Spartan Capital Securities this morning. Peter, very good morning to you. So the U.S. government shutdown, and that kind of euphoria, I think, lasted for a very short time, isn't it?
Yeah, well, we had some strong days a couple of days ago, especially in the old economy stocks, where we saw the Dow actually rise rather sharply. And that, of course, was in anticipation of the shutdown ending. And of course, the shutdown did end, and we saw a reversal of that. And I think the reason for that is twofold. One, obviously, the AI stocks are getting battered. The question of whether or not the sector will outperform is now under scrutiny. And of course, the other factor is that, we're not likely to get any macro data that is constructive macro data referring to the labor market or to the inflation numbers for October. The government has said it is going to be very unlikely that we get that. So that takes us to the next stage of macroeconomics. And that means that we're going to see part of the November data, and of course, going forward, we'll get the December data. And I think that what's happening here, or what will happen, is that the macro economic news is not going to be all that great. And so I think that the Fed, even though bets now have fallen under 50% of a rate cut in December, and of course we see this core of Fed members that continue to water down the possibilities of a Fed cut in December. I think that's going to change over the next few weeks. I think the macro news is going to indicate that the economy is not that strong. And if you look at all the layoffs that have been announced over the past 4 to 5 weeks, there seems to be not one major company that's not laying off. So that's got to be detrimental to the labor market. And of course, you have the effect of AI. The artificial intelligence is showing signs that it is beginning to erase jobs. And so I think the Fed is likely to cut rates by at least 25 basis points in December.
Wow. Well, yeah, I do have a follow-up on that, Peter, because a lot of people talking about the fact that there's a lack of data. And I get the points that you've raised so far, but then policymakers are effectively flying blind right now. And the tendency is that there is going to be a little bit of caution and they might just not pull the trigger. Why is it that you feel that they will, when a lot of other people are saying that they might hold in December?
Well, for one thing, let's look at the private forecast numbers that, ADP now has a weekly number that comes out, and it runs over the past several weeks, and it's an indication of pay stubs either being canceled or increasing. And so just this week, we saw that the economy, according to ADP, that is the private sector, lost 14,000. The week before, we saw an increase of 12,000. So there was a bit of a contrast there. And I think that when we get the official data from the government, now it's true that everyone is basically blind, and we're going on assumptions, and we're going on hearsay. But we will get the December number.
Right.
And I think that's not, and I don't think that's going to be really good. And so I think that the Fed will probably have to change its mind and reduced by 25 basis points. Now, I also want to bring out another point that same way with inflation. I think when we get those numbers, we're going to see that inflation remains sticky. We're going to see that that the flow of tariff inflation is certainly hitting the pocketbooks of the American consumer.
Got it.
And so, you know, from one viewpoint, you could say, well, the Fed has got to look at inflation. From another viewpoint, they have to look at the bond market. My guess is that they're going to sacrifice perhaps the sticky inflation and look at what's happening in the labor market, which is not a pretty picture at this time. At least, in my opinion, it's not a pretty picture.
Peter, just one quick follow out there. We saw almost everything else, including the equity markets, but Bitcoin crack as well. Safe haven demand for gold may have gone up, but otherwise other things came off. If the Fed does not cut, and overnight or over the last few days, that probability of a 90% rate cut has come off to almost a coin flip, right? If there is no rate cut, and if the market starts assuming that, do you see more downside for the US equity markets?
Well, the downside is probably a little bit more, but I think what we're seeing here is not necessarily a pullback in the general market. What's triggered the sell-off is the AI sector. And if you look at what's happening, we've had some pretty sharp corrections in a lot of these AI stocks. And the thing that attracts me here in saying that perhaps maybe we're nearing an end to this is the fact that if you look at the smaller speculative AI stocks, they're off anywhere from 50 to 60%. Generally speaking, when that happens, you're getting close to a bottom of you might, if you want to call it, the first leg of a pullback. So I kind of think that that's what we're headed for. That doesn't mean it can't resume, but I think we'll see some relief rallies over the next couple of days. And I think that, you know, we'll be subject to subject to the macro news. And let's not forget that we just getting off of a very strong earnings season. And of course, next week, we'll be hearing from retailers. And so it's going to be quite interesting to see what they have to say, especially their guidance.
Yep. So a lot to unpack there, Peter. Thank you so much for speaking with us.